Hi, welcome back. This is Judith Paquette, part 5 of Accounts Receivable chapter, and we're going to talk about notes receivable. This is our last major section in the chapter. Why would a company accept a note? For the most part, most companies do not use a lot of notes. However, there are situations where a customer may not be able to pay money owed in the typical 30-day period, and they have to extend its payments period. In this case, a promissory note is prepared, signed by the company and the borrower, with interest and a deadline or a payment date. In a perfect world, the accounts receivable is settled, and at a later date the note is paid with interest. Now, most of the notes we're going to look at this chapter are in settlement of accounts receivable, but there are other situations where companies lend money out and give the payer additional time from the usual 30 days. The due date for a note can be in months or days or years. We're going to deal with notes that are less than 1 year. For example, a note dated July 21st that is due in 3 months would be due 3 months later, October 21st. It doesn't matter that some of those months have different number of days in them. On the other hand, if a note is stated in days, you have to count the actual days. A note issued July 21st with a 90-day due date would be due October 19th. How do we calculate that? First, we take the number of days in July minus the issue date of the note, and that gives us 10 days. You do not count July 21st. You just count the difference, which is 10 days. If you counted July 21st, that would actually be 11 days. August has 31 days. September has 30 days, but that's only 71 days. We still need another 19 days to get to the 90 days, and that takes us to October 19th. If you have your course pack, or you have downloaded it, you can see this note in it. We use certain language regarding notes. Money is loaned to the company. Money is loaned by the company to the borrower. A note is created and signed by both parties. Now look at this note. Wilma Company is here, paid to the order of Wilma Company. And at the bottom we see Maker Calhoun Company, signed by the treasurer. Now it's important to know who is paying whom in this note. The note says in this case, we promise to pay to the order of Wilma Company $1,000 for value received with annual interest of 12%, signed by the Calhoun Company. So Calhoun Company is the borrower, also called the maker. Wilma Company is the payee, also called the lender. The note is $1,000. It's only 2 months. Annual interest is 12%, but the actual interest will be prorated to 2 months. Here's another example of a note, and note how it's worded a little differently. We, Cheesecake Factory, make commitment to pay to the order of Chen Company. So in this case, Cheesecake is borrowing the money, they are the maker, and they will be paying it back to Chen Company, the payee or the lender. How do we calculate interest on a note? First, you calculate annual interest, and then you prorate it for the period where the note was taken, for the time that the money was borrowed. This calculation depends on how the note is written, in days, months, or years. If it's days, then you divide the days of the note by 360. So if we borrowed for 120 days, we would we would first take the principal, $730, times the interest rate, 18%, and then prorate it times 120 days divided by 360. We use 360 for this calculation instead of 365. If on an actual test you use 365, I will accept it, but Wiley Plus and most textbooks use 360. If we do months, you again take the principal, in this example $1,000, times the interest, 15%, and then you prorate it. Let's say this was a 6-month note. We would take 6 divided by 12 months. And of course, if it's a year, you just take the principal, in this case $2,000, times interest, 12%. And you don't have to prorate it. Again, there are many types of notes receivable. Companies can grant credit for future payment or for outright loans of money. The type of note receivable we will first discuss will be in settlement of accounts receivable. Why would this happen? This is a situation where the customer just can't pay an invoice on time when it's due, and the customer and the company agree to convert the amount to an interest-bearing note. Of course, there are notes receivable for other parties who are not customers. Let's use this note. The lender is Chen Company, the borrower is Cheesecake. Cheesecake borrowed $1,000 for 2 months with an annual interest rate of 12%. So remember, this is a note that is being created to settle accounts receivable. Okay. So what that means is that earlier on, Chen Company sold $1,000 worth of something to Cheesecake Factory and logged it in accounts receivable, debit accounts receivable, credit sales. And now Cheesecake is saying, we can't pay in 30 days. Please convert this to a note and we'll pay 12%. Give us 2 more months to pay this note. So step 1 is to convert the accounts receivable to notes receivable. We debit notes receivable and we credit accounts receivable, getting rid of the accounts receivable. How much interest will Cheesecake owe? Well, do the math. 1,000 times 12% is $120 a year, divided by 12, multiplied by 2 months, and you get $20 of interest. So when Cheesecake pays the final note, they'll pay $1,000 plus the $20. Now, before we get to the final payment of the note, let's remember when we value accounts receivable, we have allowance for doubtful accounts. When we value notes receivable, we also have to estimate how much do we think we're going to collect. And if it's lower, then we have to add money to allowance for doubtful accounts. So now we can talk about collection of the accounts of the note receivable. Ideally, notes are held to their maturity date and then paid. Sometimes the borrower or the maker may default and not be able to pay their loan, and we have to make an adjustment to the account. Sometimes the company says, I'm going to sell this note receivable to a factor and let the factor collect it. So when the customer pays the note on time, we say that note has been honored. When the customer cannot pay the note, we say it is dishonored. And we have to make a transaction for a dishonored note. It is no longer negotiable. Let's take an example. Assume that Sound Equipment lends Local Burger $10,000 on June 1st, accepting a 5-month 9% interest-bearing note. Now in this case, this is not in settlement of accounts receivable. This is just a note. So we are doing Sound Equipment's books. Sound Equipment loaned $10,000 to Local Burger, that would have been a transaction, an earlier transaction on June 1st, and it would have been debit notes receivable for $10,000, credit cash for $10,000. What you see below here on November 1st is the collection. Note receivable is credited for $10,000, cash is debited for the $10,000 plus the $375 for interest, and interest revenue is recognized for $375. How did we calculate the interest? We took $10,000 times 9%, and then we prorated that $900 times 5/12. Often, financial statements are created before the loan is due, so in this case, all interest must be accrued. If Sound Transit prepares financial statements as of September 30th, that means 4 months have gone by for that 5-month loan. So remember, $10,000 times 9% is $900, and we're going to prorate it as of September 30th, and that will be $300. So when we publish financial statements on September 30th, we have to recognize the $300 of interest revenue that have been earned. On the actual due date, November 1st, when Sound Equipment records the payment of the note, it will still record that same amount, cash $10,375. It will still credit notes receivable for $10,000. But now it's going to clear out the interest receivable for $300 and the interest revenue for $75. Let's do the journal entry for a dishonored note. Assume that Local Burger cannot pay. If Sound Equipment expects eventual collection, it needs to transfer the note receivable balance back into accounts receivable with interest. The reason for that is because the note is no longer negotiable. It has been dishonored. And here we have it. Accounts receivable is upped by $375. Notes receivable is cleared. And interest revenue has a credit of $375. Finally, we have some ratios related to accounts receivable. The accounts receivable turnover ratio and the average collection period. The receivables turnover ratio is an indicator of how fast a company is collecting its accounts receivable. That is, how many times a year is it turning over accounts receivable? Like inventory turnover that you learned about in Accounting 201, accounts receivable turnover is a measure of throughput. The calculation is net credit sales divided by average net receivables. Note that average net receivables is a calculation of this year's accounts receivable ending balance plus last year's accounts receivable ending balance divided by 2. For this ratio, higher is better. You want to turn over your receivables more times every year. Average collection period uses this answer from your previous slide and divides it into 365 days. This gives us an average days of accounts receivable. For this calculation, lower is better. Think about it. You want your receivables collected in less days, not more days. All right, let's practice. The LeBron James Company had net credit sales of $923,795 for the year. It had beginning, remember those are credit sales, we don't use cash sales for this calculation. Had a beginning accounts receivable balance of $38,275, ending accounts receivable balance of $35,988. And note that these are net balances, accounts receivable minus allowance for doubtful accounts. Net credit sales divided by average accounts receivable, and we have accounts receivable turnover of 24.9 times. And I got to tell you, that's pretty fast. Take that 24.9 divided into 365, and that means that the LeBron James company is collecting its receivables in an average of 14.7 days. Be sure to put days at the end of this collection period and times up here. 14.7 days makes it really clear how fast we're collecting that money. When you have accounts receivables, it's important to manage them. Some customers pay automatically, other customers require a phone call. I worked in accounts receivable for about a year and a half, and I did a lot of phone calls. A company needs to have a consistent payment policy, but also a competitive one. Don't ask for faster payment than your competitors. On the other hand, Walmart was able to pay its own bills in 90 days, even though much of the industry was paying their bills in 30 days. That is the power of a large corporation. A company should analyze its accounts receivable weekly or monthly and be prepared to update management on when cash is expected to come in, as well as warn management of possible problem accounts. So figure out whom to extend credit to, make a clear payment period policy, monitor collections, call your customers if they haven't paid promptly, evaluate the liquidity of receivables. Do we really think we're going to collect these or not? And then accelerate cash receipts from receivables by selling them if you need to. This ends part 5, and this ends the video for this chapter.